Well, the issue, of course, is still the same one, that the impairment to business is not just about the virus, which now thankfully seems to be well past its peak in most places in the world, despite the slightly misleading rise in case counts. We still, however, have many government restrictions. And what's worse, we have the flip-flopping with government actions. We let somebody out, we put them back in. You can travel here, you can't travel there. I mean, how does a big business, as usual, has some padding, has different arms in different countries. How does the small business cope with all this? And the small business may not be the most profitable of entities, but it is usually the one that generates the most activity, the most growth, and employs the most people. So this is very difficult.
Is there any need, though, to worry about the continual rise in debt levels as we tackle the consequences of this stop-start recovery? It seems with the central banks on the case here, there isn't going to be a problem with so-called bond market vigilantes stepping in and saying enough is enough.
No, I'd agree with you there. At the moment, it looks like it's free money, doesn't it? It looks like the tooth fairy is fluttering over every chancellor and every finance minister in the world. But ultimately, if we issue obligations today and don't generate enough real growth and enough real income to service and perhaps even pay them down, then we are going to end in trouble somewhere. For now, it looks like a cheap option. The central banks have pegged interest rates at or below zero in nominal and definitely in real terms. And chancellors and finance ministers everywhere don't want to do anything unpopular by raising taxes. So it looks like that is the trade. And as you say, while the central banks are there and while people still have confidence in this procedure and are eager to exploit it, then we won't see an immediate problem. But clearly it's storing one up.
Well, given that as we look at the markets at the moment, there seems to be no expectation that we're going to get higher inflation and no expectation that we're going to get higher interest rates. And increasingly, it looks as though the recovery is going to be on a steadily upward gradient, but a little bit stop-start. Is there any reason at this point to check out of the equity market rally that we see?
Well, the equity market rally has, of course, been dominated by 4 or 5 big names, some of which have clearly shown all the signs of herding, speculative mania, whatever you name it. We've seen all the stuff about Robin Hood. We've seen the things about option squeezes, so on and so forth. 4 or 5 stocks have been responsible for much of the growth. But actually, if you look back at something like the Value Line Index, which is a broad, equally weighted index, which is therefore not so dominated by the FANGs, then that's not, it's only a couple of % off its highs. Now, is that a reflection of economic optimism? Well, certainly we've had something of a rebound from the awful trough of the spring, but are we going to go up and away to justify these valuations? The large underpinning of the valuation, as you've led me into here, I think deliberately, is, of course, the low interest rates and the prospect that you're never going to earn anything on your bond portfolio, so you have to do something with your investments. But it's a pretty shaky basis to be pushing things to all-time highs and all-time high multiples in some cases.